All right, let's just jump right into this explainer where we're going to break down the exact differences between trading and investing so you can safely and effectively navigate the stock market. You see, you can make a lot of money with both, but they are entirely different paths to wealth. If the stock market is a journey, well, trading is kind of like sprinting for quick rewards just a few steps away. While investing is a long-distance marathon where the real payout takes years. By the end of this, you'll know exactly which path to choose to start building your own
So
wealth.
you want to earn from the stock market, but honestly, you're just not sure where to start? We hear this all the time from beginners. To clear up the confusion, let's look at a totally relatable example. Let's talk about a guy named Boboro. Now, Boboro runs this great business, buying mobile phones for cheap and selling them at a shop for a really solid profit. But one day, the market dynamics completely
Okay,
changed.
here's the deal. Baba Rao used to sell his phones for 10,000 rupees. But a new competitor, Totla Saith, opens a shop right across the street and starts selling the exact same phones for just 9,000. Naturally, all the customers start flocking to Totla Seth. And while watching the news in his empty shop, Baba Rao hears that a massive mobile chip shortage is about to halt all manufacturing. The supply is literally about to stop, but customer demand? It's still extremely high. So now, Bobarao faces a really tough choice on how to capitalize on this upcoming shortage. And this dilemma, it is literally the stock market in a nutshell. Option A is daily trading. Baba Rao could wake up every morning, buy out Totla Seth's cheaper inventory at 9,000 rupees, and just immediately flip it at his own shop for 10,000 to make a quick daily profit. Option B, though, represents the long-term game of investing. Baba Rao could buy those cheap phones and just stash them in a warehouse for months. Once that chip shortage truly hits and market prices skyrocket, he can sell them for 12,000 or even more. Simply swap out mobile phones for shares of a company, and boom, you have the exact difference between a stock market trader and an investor. To build our foundation, here is a quick look at our agenda for this explainer. 1. Defining trading and investing. 2. Research, risk, and stress. 3. Costs, taxes, and capital. And 4. Which is actually best for you. All right, let's kick things off with part 1. Defining trading and investing. The absolute biggest fundamental difference here is time. Trading seeks profits in minutes, hours, or days. You buy a stock in the morning and, sell it by the afternoon. Investing, however, requires the patience of years or even decades. Investors find a solid company, plant their money like a seed, and just wait for it to grow over 5, 10, or 20 years. But why wait years, right? Well, here's why waiting pays off. When you invest, your money helps a company launch new products, hire more employees, and expand its business. And when the company makes a larger profit because of that expansion, they want to keep you happy. So while waiting years for a stock price to rise, investors also get periodic dividends. Over time, these small cuts of the company's profits can become a massive income stream all on their own. Seriously, some long-term investors make millions just from dividend payouts alone. Now, the way these two camps operate is kind of fascinating. Traders, they don't actually care what a company does or who manages it. They use technical analysis. They wake up to look at charts, track momentum, and predict short-term price movements to find quick opportunities. Investors, on the other hand, use fundamental analysis. They deeply research the company's future potential, analyze the management team, and study the balance sheets to make absolutely sure it's a safe place to park their money for the next decade. Moving right along to part 2, research, risk, and stress. Because the stock market isn't just numbers on a screen, is it? It's heavily driven by human psychology. Okay, I need to get super real with you for a second. 90% of new traders lose 90% of their money within their first 90 days. It's a brutal statistic. Trading is incredibly complex and risky. It is a space dominated by seasoned, cutthroat professionals, and beginners who jump in hoping to make a quick buck almost always get burned. You can kind of think of trading like a giant, high-stakes game of heads or tails. People are betting on whether up or down. If the price goes up, the buyers win and the sellers lose their money. The wealth is literally just transferring from one pocket to another. But here's the kicker. No matter who wins the coin toss, the broker facilitating the trade and the government collecting the tax are always taking a cut. That puts the trader at a massive advantage. Investing is totally different. If you pick a good company, it actually creates new wealth as it grows, meaning everyone who holds the stock wins over time. And because of all this, these two paths lead to entirely different lifestyles. Imagine being glued to a screen in constant stress. Every tiny drop in price makes your heart pound, and every spike brings this crazy rush of adrenaline. It is emotionally exhausting. Investors, however, simply buy good companies and sleep peacefully. They might check their portfolio once a month or maybe even once a year. A drop today doesn't matter to them at all because they are looking at a 10-year.
Okay, let's jump into part 3, costs, taxes, and capital. Because at the end of the day, it's not just about what you make, it's about what you actually get to keep. Let's break down the tax and brokerage comparison. Because traders are constantly buying and selling, they rack up huge brokerage fees on every single transaction. It adds up fast. Plus, short-term trading profits are usually taxed much higher, around 28%. Long-term investors, though, they make very few transactions, keeping their brokerage fees incredibly low, and their long-term capital gains are taxed at a much friendlier rate of around 20%. But hey, the really cool part? Both paths are super accessible. You can literally start with just 100 rupees. Brokerage fees generally range from a tiny 0.03% up to a flat 20 rupees maximum per trade. And for investors buying delivery shares, meaning you are actually taking ownership and holding the stock, some brokers won't charge you a single rupee and might have a small annual maintenance charge. Just remember, if you want to jump into complex trading derivatives like futures and options, you're going to have to submit proof of income, whereas basic investing just requires a standard Demat account. Now, when we're talking about capital, trading can let you flip small amounts of cash crazy fast. If you're highly skilled and, let's be honest, pretty lucky, you could turn 1,000 rupees into 5,000 incredibly quickly. But the risk of losing that entire 1,000 rupees is massive. Investing, conversely, utilizes the sheer magic of compounding. No, it won't turn 1,000 rupees into 5,000 overnight. It requires consistent capital over a long. But the risk of a total wipeout in strong, fundamentally sound companies, it is incredibly low. So, down to the wire. Part 4, which is best for you? We've weighed the pros, the cons, the risks, and the costs. Just dipping your toes into the market, I highly, highly recommend following these 3 steps. First, start safe. Begin by investing in delivery shares. This lets you track market movements and understand how things work without the intense risk of losing everything in an hour. Second, use a reliable app with a simple interface, Zerodha, Angel One, or Upstocks, because the absolute last thing you want is a platform crashing while your hard-earned money is on the line. And third, only try trading once you have real, solid experience. And please, only use money you can genuinely afford to lose. Actually, if you're a working professional pulling in a regular monthly salary, the safest bet is pretty clear. You absolutely do not need to endure the panic of daily trading. If your main goal is just to ensure a secure, wealth, sticking to long-term investing in solid companies and mutual funds is a proven, reliable strategy that works. I want to leave you with this one final thought to kick off your financial journey. Are you looking for a quick thrill that might cost you absolutely everything? Or are you ready to patiently build an empire? Understanding the difference between trading and investing is just the first step toward taking control of your financial. So what's your next move going to be? Choose your path wisely and let your money start working for you.